Credit spreads basically selling options and then buying another option at a lower strike price to hedge your downside. That's called credit spread. It's very popular, they're very powerful, they're very high probability trading. So step one, these are usually weekly trades that I do, mostly after earnings. So step one, you look at the calendar, pick the stock that just had a catalyst. In this case, they just had their earnings. Step two, you wait a few days after the earnings is out, after the catalyst is out. You see if the stock has gapped down, if it's continuing to sell off, if it's gapped up and it's like continuing to go up. You wait for key areas of support or resistance to show itself. And then step three is picking the right strategy, which today's presentation we're going to talk about credit spreads mostly. You set them up, you manage the risk. You use those binomial trees that I showed you, you use your risk management that I showed you, and try to have it that it will give you a positive expected value at the end of it. So here's an example. Chevron, this is for earlier in the year on a Friday. It has earnings. Earning comes out, the stock sells off. So earnings actually quite good. The stock, however, sells off. So you see this large red candlestick, stock open higher, closed lower. You can also see there's like a little double top action here. There is a area of resistance here, couldn't break above this level, and the stock is going down. So what do you expect now with this information, given that the earning just happened, the catalyst just happened? What do you expect the stock's gonna do?
Come a little lower and take support.
Okay, very nice. Come a little lower and take support. That's what you would expect the stock to do, right? You would expect, because the catalyst is out, you already got this resistance area that wasn't able to break higher, you would think the stock's probably going to consolidate around here.
Yeah.
Right? That's what you would guess it would do. So how could you play this as an option trader in these setups? By the way, these type of setups show itself day in and day out in the market. Every time after earnings, the stock gaps down 20%, gaps up 20%. You get these type of setups all the time. Now it's just a matter of really understanding, okay, how to manage these credit spreads and actually try to make profit off them. So if this is the setup, and if you think, as this gentleman correctly identified, you think the stock's going to go down or consolidate, as a credit trader, how would you set up a trade here?
Sell the puts lower.
Sell the puts, yeah, sell the calls, right? So you could sell the puts too, but remember the earning was bad, so you don't know if it might keep coming lower and you might get assigned. So selling the put might not be a good idea, but you definitely know that the stock's not going to go higher. So maybe sell some calls at the 185 level and buy some calls at 190 level for protection. That's called a credit spread, right? Because the 185 gives you more money than the 190 calls that you're buying. You end up with a premium, with a surplus of premium. That's why it's called a credit spread. So you can go ahead, set this up, and watch it decay. Every day that goes by, part of that premium decays and more money comes into your pocket, right? Every day that goes by. Now, why credit spreads? The risk is defined. Why after earnings, implied volatility is still high, even though you got that volatility crash, implied volatility is still high. You get paid really good premium for selling the option. Time is working in your favor. In general, these credit spreads are really high probability trade. Remember, high probability doesn't mean free money, right? There's no free money or free lunch in the market, but they are high probability trade, and I'll show you. And they're easy to manage and hedge, which I'll talk about as well.
You're saying IV is still high, like even 3-4 days after the earnings event?
Yeah, so IV
Higher
is...
than what it was prior?
No.